Have you ever wondered how the stock market operates and why it's so critical to the global economy? This vast financial landscape might seem intimidating, but let's break it down. At its core, the stock market is a place where companies sell shares or pieces of ownership to raise capital. When you buy a stock, you're essentially buying a tiny piece of that company, hoping its value will rise over time. Now, where does all this buying and selling happen? Welcome to the world of stock exchanges like the New York Stock Exchange or the Nasdaq. They provide a regulated, transparent platform for these transactions to occur. But stocks aren't the only game in town. Fixed income instruments like bonds provide a steady stream of income over a certain period. And then there are funds. Imagine a basket filled with different investments handled by professionals. That's a fund for you. Now that you have a basic understanding of the stock market, let's dive deeper into a popular investment option: ETFs. Ever heard of index funds and ETFs but not sure what they mean? Well, you're not alone. Let's break it down. An index fund is a type of mutual fund with a portfolio constructed to match or track a specific market index. The goal is not to outperform the market but to mirror its performance. This approach is often referred to as passive investing. Now, ETFs or exchange-traded funds are similar to index funds in that they also track a specific market index. However, unlike index funds, ETFs are traded on the stock exchange, just like individual stocks. This means they can be bought and sold throughout the trading day at fluctuating prices, whereas index funds can only be traded at the end of the day at a set price. Both these investment tools are popular because they provide diversification, which can reduce risk, and they typically have lower fees than actively managed funds. ETFs have proven to be a popular choice for many, but why is that? Stay tuned to find out. Why do many investors, especially beginners, prefer ETFs over other investment options? Well, there's a multitude of reasons. First off, ETFs typically have lower costs compared to other investment options. This is because they passively track an index, rather than actively managing assets, which can lead to hefty management fees. Secondly, ETFs offer the benefit of diversification. When you buy an ETF, you're not just buying a single stock or bond, you're buying a basket of them. This spreads your investment across many different assets, which can help to reduce your risk. This brings us to another crucial benefit of ETFs. They help to mitigate idiosyncratic risk. That's the risk associated with a specific company or industry. While ETFs do expose investors to systematic risk, which is the risk that affects the entire market, they allow you to diversify away the idiosyncratic risk. ETFs certainly have their benefits, but how do you go about investing in them? Ready to make your first ETF investment but not sure where to start? First things first, you'll need to open an account with a reliable online broker. Do your research and choose a broker that offers a wide range of ETFs and has a user-friendly platform. Remember, this is where you'll be making your trades, so it's crucial that you feel comfortable navigating through the platform. Once you've set up your brokerage account, it's time to choose an ETF. Consider starting with something broad and less volatile like the MSCI World. This ETF tracks the performance of large and mid-cap companies across 23 developed markets worldwide. It's less risky because it's diversified across a wide range of companies and sectors. Alternatively, if you're feeling a bit adventurous and want to tap into the potential of developing economies, consider the MSCI Emerging World. This ETF is a bit more volatile, but it provides exposure to companies in emerging markets, which could potentially offer higher returns. After choosing your ETF, the next step is to execute a trade. In your brokerage account, search for the ticker symbol of the ETF you've chosen. Then simply input the number of shares you want to buy and click on the Buy button. It's really as simple as that. But remember, investing is not a one-time event. It's an ongoing process. You'll need to regularly monitor your investments, review their performance, and adjust your portfolio as needed. This could mean buying more shares, selling some off, or even switching to a different ETF. Also, it's important to remember that while ETFs can offer diversified exposure and potentially higher returns, they also carry some level of risk. So, be sure to do your due diligence before making any investment decisions. There you have it. A comprehensive beginner's guide to understanding the stock market and investing in ETFs. Remember, every investment carries some risk, so always do your homework before diving in.